The latest reading on gross domestic product was released on Tuesday morning, showing the economy grew by 5% during the third quarter compared to a previously reported 3.9%. Economists were expecting 4.3%. I'm joined now by Ward McCarthy, chief financial economist at Jefferies. And Ward, this is the largest increase in GDP since 2003. Also, second quarter's GDP was revised higher to 4.6%. What's your take on these numbers?
Well, it's a confirmation that the U.S. economy has reasserted itself as the leading economy in the globe. It also is a confirmation that the U.S. economy continues to build critical mass and can generate solid job growth over a period of time. So we've averaged over the last 2 quarters growth of 4.8%. I don't think we can match that on a consistent basis, but I do think that we should expect to see growth rates of around 3.5% going forward.
Now, the Federal Reserve insists its decisions are driven by data. And of course, the decision we're talking about is their looming one over when to raise short-term interest rates. Do you think that some of this data will make a stronger case that the Fed should raise short-term rates sooner rather than later?
No, I don't think so. I don't think we're there yet. The Fed has a dual mandate. It's made a lot of progress towards the full employment objective, but it hasn't reached that objective yet. And I think it will probably take until towards the end of next year before you can objectively look at the labor market and say, you know, the Fed has accomplished this mission. On the inflation side, the Fed is moving in the wrong direction. Later on this morning, we'll probably see a dip in the PCE deflator, and that will decelerate and move away from the 2% target. And the Fed hasn't hit that target since April of 2012. So this is an environment in which the Fed can afford to be patient. They've told us that. And I think they will be very patient before they decide to pull the trigger.
Now, moving on to some of the other economic data released this morning, durable goods fell 0.7% in November. This is the third decrease in the last 4 months. Does that concern you?
Yeah, it does concern me, actually. I'm pretty optimistic about the U.S. economy, but I am getting a little bit concerned about the CapEx picture. When you break down the composition of the durable goods numbers, it again showed that we really had no more momentum in CapEx orders. So if you go back to August, September period, CapEx orders were up about 8-9%, on a year-over-year basis. Now they're only up 0.6%. So if this were to continue, it would raise some concerns for me. But we also have to keep in mind that the durable goods orders are the most volatile of all of the economic data releases, and you really need to look at them over a period of time.
Let's talk about oil prices. How do you factor in the slide in crude with the broader economy? It seems like low oil prices are here to stay, at least for the next several months. But do you think consumers actually believe that to the extent that it will cause them to go out and spend more?
Well, it looks like that's already happening. For example, if you look at consumer sentiment numbers, they've improved if gasoline prices have gone down. And gasoline prices are really what matters as far as the U.S. consumer is concerned. And the declines in gasoline prices so far amount to a tax cut of as much as $75 billion on an annual basis. So it puts money in consumers' pockets, especially those who are in the lower half of the income strata, and it makes everybody feel better when you go to the gas station and it costs you $20 or so less than it used to fill your tank. So we've seen signs in weekly consumer spending numbers and on monthly consumer spending numbers that the consumers are reacting as you'd anticipate to this increase in what amounts to an increase in discretionary income.
All right, Ward McCarthy, chief financial economist at Jefferies. Thanks for your time this morning.
Thank you.
I'm Scott Gamm, and you're watching The Street.